on your Blackboard as lecture notes. So the break-even point, okay, is one of the application of the cost of volume profit analysis. So last time we talked about, and the break-even point is your total fixed asset. Okay, total fixed asset. Remember the fixed asset? So we have FC divided by the contribution margin per unit. Okay, so it's the price minus the variable cost per unit. So we call this numerator is your total fixed asset. The denominator is your contribution margin per unit. Okay, in dollar value, we call them as contribution ratio, contribution margin ratio. Okay, for example, this is how you calculate break-even point. For example, you have unit price is $15, right? Unit price is $15. And your variable cost is $5 per unit. Okay, now you can have the contribution margin ratio or contribution margin per unit is unit price minus variable cost per unit. Okay, and then you less your fixed cost. The fixed cost is 20,000. So you're just using 20,000 divided by contribution margin per unit. Okay, that's the break-even point. Is 2,000. So this are kind of easy for you, break-even point. So I'm pretty sure so everybody will get correct. More likely, you are not going to lose point on break-even point analysis. However, so we have quite a students made mistakes on calculating the degree of operating leverage. So the degree of operating leverage is a measure to the extent of the change in operating income resulting from change in sales. So what that means? Okay, basically degree of operating leverage is the percent change in your operating income divided by the percent change in your total sales. Okay, you might sell a lot of product, but you didn't earn much operating profit, right? Operating profit. So we either you're using percent change, either you're using this formula. Okay, this formula is called contribution margin divided by your operating income. Okay, let's look at the example here. Okay, the following information pertains to last week's operation of XYZ company. The company sold 2,500 units at $25 each. The variable cost per unit is $15. Okay, so the total revenue is the total sales. Okay, your total revenue is your total sales, which is the products they sold in units times the unit price. Okay, this is 225, 2,500 times $25. That's the total revenue. Okay, 62,500. The variable cost is $15 times 2,500. Okay, that's giving you 37,500. That's your variable cost. Your total sales minus your variable cost, what is that called? This is called contribution margin. Okay, it's contribution margin. And that is contribution margin is that sales revenue minus your variable cost is 25,000. And then you less your fixed cost, okay, 15,000. That's your operating income. Okay, operating income is another name is called EBIT, right? EBIT in your income statement. So the degree of operating leverage is going to be your contribution margin divided by operating income. Contribution margin is 25,000. That's operating income is 10,000. Okay, degree of operating leverage is 2.5. Okay, when you have the degree of operating leverage, so what that means? The meaning is that if your sales revenue change by a certain percent, operating income will change by 2.5 times the percent change in sales. Okay, for example, if your sales increase 10%, your operating income will change 25%. But that's we call this company has degree of operating leverage. This measures the business risk, or the company's business risk. Also, we can have the sales revenue in the format of this old and new. Okay, if the question is given to you, okay, this is the old sales, which is like 2015, and the new sales is 2016. Okay, so you can do is this using the percent change in your total sales. So what is the percent change? The percent change in, you can use 68. Okay, the new minus old divided by old. So that's going to be 68,750 minus 62,500. Okay, you get the difference between these two, and I use this difference divided by 62,500. So that's the sales revenue increase. The sales revenue increase 10%. So how you get the 10%? Okay, it's this one. Okay, the 10% is basically this number minus that. Okay, and then you save that. Okay, the difference is going to be your numerator, and the old is going to be your denominator. So that's how you get 10%. Okay, and operating income. So the operating income is going to be this is the new divided by old. Okay, minus old and divided by old. So it's going, so using the difference, right? So this is going to be percent change in operating income divided percent change in sales. Okay, so how you get a percent change? The percent change is going to be, okay, the percent change okay, percent change is going to be new minus old divided by old. Okay, that's how you get a percent change. Okay, it could be in different formats. It could be in different formats. Okay, the degree of financial leverage. Okay, the degree of financial leverage we call DFL. Okay, so what is degree of financial leverage? So if you have a higher degree of financial leverage, that means the company has higher financial risk. Okay, the company will have financial risk. We can use the formula to get the degree of financial leverage. Okay, so the degree of financial leverage, you can see is the percent change in earnings per share divided by percent change in operating income. So operating income or EBIT. So EBIT is operating income. So the degree of financial leverage, okay, is going to be your new earnings per share minus your old earnings per share divided by old earnings per share. And then you divide it by the whole thing, okay, is new EBIT minus old EBIT divided by old EBIT. Or you simplify this formula, okay. Simplify this formula. It's going to be your EBIT divided by EBIT minus interest expenses. Okay, minus interest expenses. Now remember in our textbook and all the lecture notes, is a EBIT minus I. But sometimes the students confusing with the I and the number 1. So it's always confusing. Every year I see students using EBIT divided by EBIT minus 1. Okay, that's not correct. So I'm not joking. So it's that's for real. So every year we have a student doing that. Okay, remember that's not EBIT minus 1 here. It's EBIT minus interest expenses. Okay. So we give you an example how to calculate degree of financial leverage. So ABC company is preparing to launch a new project that requires substantial external financing. Okay. Currently, the company's EBIT is 500,000 and the interest payment are 100,000. Okay, so you have EBIT and the interest expenses. So use the 500,000 divided by 500,000 minus your 100,000 interest expenses. Okay, degree financial leverage is a 1.25. Okay. How you interpret your result? Okay, it shows that 1% change in the company's leverage will change the company's operating income by 1.25%. Okay, so it's going to 1.25. Okay, 1.25 is the percentage change in earnings per share, percentage change in operating income. So 1% change in operating income will result in 1.25% in earnings per share, right? Okay, that's the degree of financial leverage. So if you calculate the degree of combined leverage, you can simply use degree of operating leverage you calculate times the degree of financial leverage. Remember, we got degree of operating leverage is 2.5, and then you times 1.25 for the degree of financial leverage, right? So you can get the solution of a degree of combined leverage. So the degree of combined leverage, what is that? It's going to be, okay, percentage change in earnings per share divided by percentage change is not in EBIT, it's in total sales. Okay, so your percentage change is in your total sales. Okay, any questions? Okay, so that's a 4 degree of combined leverage. Okay, I just want a summary of the exam B. So we are gonna have exam B. We have financial analysis. Okay, might be, you know, it's not all. Everybody will got a different question, and then of course you have time value for money questions, and you have risk and return. And you have weighted average cost of capital, the capital structure, the cost of capital. and you have capital budgeting. Okay. So financial leverage, risk return, and bond valuation, stock valuation. And then we have today. Okay, today we have the break-even point, degree of operating leverage, degree financial leverage, degree of combined leverage, capital structure. Okay, this is the last lecture for this semester. So next week we do not have a Zoom meeting anymore. So I wanted you to concentrate on working on your final exam. And so feel free to send me your email if you have any questions. Okay, don't forget to type your name in the chat box. Are there any questions? Okay, no questions. So we're gonna end the meeting.
Are you gonna have any office hours or like Zoom kind of stuff for next week? Or like just like any tutoring sessions you could have?
So next week we do not have any Zoom meeting, or you can send me email. So if you you have a specific question, so we can just do a Zoom meeting individually.
Okay, cool.
Yeah.
Would you say the projects would be pretty helpful on the final? What we've done for our projects?
Yeah, really, that's going to be really helpful. And you have project, right? And also the lecture, Zoom meeting. So I remember, so I covered at least the time value for money, risk return, and WACC, capital budgeting, right?
Mm-hmm.
This one we covered today. So it's yeah, I think most of them we covered it through like a Zoom meeting.
Okay. And you've posted all of those already?
And the links, or you think about the lecture notes?
Just the recordings.
Yeah, it's all of them. You can see each weekly assignment we have. One is called webinar. The webinars is basically is not required for student already attend the Zoom meeting. But if you still wanted to go back to review, so it's uploaded in there. So you just click on the link I provide under webinars. It's a YouTube video. So I record everything already.
Okay, thank you.
Okay. Okay, that's all for today.